As we head into the weekend, we need to talk about Rezolve AI PLC. The U.S. markets are now closed for the week, and Rezolve, trading under the ticker RZLV, finished Friday's session on November 14, 2025 at $2.95 per share. That was a modest drop of about 2 cents, or 0.67% on the day. However, in the after-hours session, it did tick up, gaining about 4 cents. As we head into the weekend, we need to talk about Rezolve AI PLC. The U.S. markets are now closed for the week, and Rezolve, trading under the ticker RZLV, finished Friday's session on November 14, 2025 at $2.95 per share. That was a modest drop of about 2 cents, or 0.67% on the day. However, in the after-hours session, it did tick up, gaining about 4 cents to sit at $2.99. That closing price of $2.95 might seem quiet, but it hides what was actually a very turbulent and high-stakes day of trading. The stock traded in a wide range from a low of $2.715 all the way up to $3.07, and it did so on massive volume. More than 13.5 million shares changed hands. That's a huge figure, and it points to a significant disagreement in the market about what this company is actually worth. And frankly, the surface-level data doesn't even begin to tell the real story. The most critical information about Rezolve didn't happen in Friday's price action, but in the institutional filings that have been dropping all week, showing that while many retail traders are frustrated, some of the largest firms in the world, including BlackRock and Geode Capital, have been reporting that they are building their positions. The common belief about Rezolve AI is that it's just another speculative, high-risk AI stock that came public through a SPAC merger. Many people look at the chart, see it's down significantly from its 52-week high of over $8, and lump it in with all the other post-SPAC failures. They see a company that, as of its last quarterly report, had widening net losses, reaching nearly $29 million, while bringing in only about $3.16 million in revenue. The expectation for many is that this is a company burning through cash with a story that is simply too good to be true, and that the constant share dilution, which has been substantial over the last year, will eventually sink the stock to new lows. This perspective is understandable, especially in an economic environment that has been brutal to unprofitable technology companies. The market has been rewarding proven earnings, not ambitious 5-year plans. And Rezolve is all about its ambitious plan. But the reality of the situation is profoundly different, and it's creating one of the most interesting tensions on the market right now. The expectation of failure is colliding with the reality of aggressive, well-funded expansion. First, let's talk about the funding. Just last week, on November 5th, Rezolve announced it had completed an oversubscribed $200 million financing round. In this market, oversubscribed is a critical word. It means that when the company went out to raise cash, more institutions wanted in than the company was even planning to take. This is not the behavior of a market that believes a company is on the brink of failure. This capital infusion completely changes the risk profile. It provides a significant runway to execute its plan, taking the immediate threat of insolvency off the table. Second, the company is immediately putting that cash to work, not just on marketing, but on talent. On November 12th, Rezolve announced it had hired a slate of new senior executives from companies like Apple, Google, Microsoft, and SAP. These are not an easy group of people to poach. Professionals of that caliber do not leave secure, high-paying jobs at tech royalty to join a sinking ship. They join because they believe in the technology and the new $500 million annual recurring revenue target the company has set for the end of 2026. This is where the short-selling story gets fascinating. There is a significant bet against Rezolve, but it's not the kind of bet you might think. According to the most recent data from Fintel, the short interest stands at about 12.18 million shares, which is roughly 8.16% of the float. That's a notable number, but it's not the kind of extreme percentage that typically precedes a massive squeeze. In fact, days-to-cover ratio is only 1.10. This is a very low number, and it means that short sellers would not have a difficult time buying back their shares to close their positions if they needed to. This low days-to-cover figure suggests that any squeeze attempts would likely fizzle out quickly. The short sellers are not trapped. So, what is their thesis? It's a straightforward bet. They're looking at that 500 million ARR target for 2026, comparing it to that $3.16 million quarterly revenue from June, and they're betting it's an impossible leap. They're betting that the company will burn through its 200 million, the new executives will fail to build traction, and the massive dilution will ultimately prove the stock's undoing. But here is the actionable part that most investors miss. You have to look at how the stock is being shorted. The data shows that the off-exchange short volume ratio has been incredibly high. On November 10th, it spiked to a massive 54.39%. On November 12th, it was over 31%. This means that on those days, a huge portion of the selling pressure was happening in dark pools, off the public exchanges. This is a tactic often used by institutions to build or exit positions without causing immediate price swings, but it can also be used to apply steady, non-visible pressure to a stock's price, weighing it down without triggering the kind of public panic that would come from a massive sell-off on the lit market. For any investor, this is a key metric to watch. You can find this data through services like Fintel or by digging into FINRA's own reports. When you see a stock's price struggling to advance on high volume, but the on-exchange data looks normal, checking the off-exchange volume is a critical next step. It can reveal the hand of larger players. What's your read on that 54% off-exchange short volume? Is that just institutional hedging or a clear sign of price suppression? The borrow fee rate, which is the interest rate short sellers have to pay to borrow the shares, has been hovering between 8 and 9.7% recently. This is elevated. It's not the triple-digit rate you see in a full-blown squeeze, but it's expensive. It shows there is consistent, costly demand to bet against Rezolve. The shorts are paying a premium to maintain their position, betting that the company's fundamentals will eventually crack. So you have a three-way battle. The shorts making a fundamental bet on failure, the company armed with $200 million in new talent, and now the institutions. The 13F filings this past week are the counter-argument. Seeing names like BlackRock, Vanguard, and Geode Capital Management either initiating or adding to their positions is a powerful signal. These are not fast-moving traders, they are long-term holders. They have certainly seen the same cash burn numbers and dilution figures as the shorts, but they have come to a different conclusion. They are likely betting that the $200 million raise and the new leadership team mark a fundamental shift, and that the company's valuation is now low enough to represent a compelling entry point for a high-growth story. This forces us to ask what Rezolve AI actually does. There is some confusion here, as there is a private company with a similar name, Rezolve.ai, that focuses on internal IT and HR support desks. RZLV, the public company, is entirely different. It is a pure play on e-commerce. Its core products are the Brain Suite and the BrainPower LLM, which is their proprietary large language model. They sell this technology to retailers to, as they put it, power agentic commerce. The idea is to move beyond simple search bars and chatbots. They want to create an AI agent that can have a natural conversational interaction with a shopper, understand their needs, and then not only find the product, but handle the entire checkout process. This is why their recent acquisitions are so important. In October, they acquired Subsquid, a decentralized data platform, and SmartPay, a digital asset payments company. They're not just trying to build a better chatbot, they're trying to build the entire back-end infrastructure, the data layer, and the payment layer for a new kind of autonomous shopping. This is an incredibly ambitious goal. It's a bet on fundamentally changing how people buy things online, moving from a search and click model to a conversation and fulfill model. This brings us back to the stock's recent performance. The high volume churn we saw on Friday, with the stock opening low at $2.715, fighting its way above $3 and then closing back at $2.95, is the perfect picture of this market's indecision. The November 12th press release with the $500 million ARR target should have been a massive, unadulterated positive, but the market is skeptical. It's asking for proof. The recent volatility is the paper trading retail crowd and the active short sellers hitting heads with the quiet long-term institutional accumulation. You can see this sentiment on forums and social media, where there is a clear divide between those who believe the company is a trillion-dollar idea and those frustrated by the constant dilution and lack of price movement.
The reality is that the $200 million raise has bought the company time, and the new executive hires have bought them credibility. The entire story now hinges on one thing: execution. Looking forward, the risks are clearly known. The primary risk is that $500 million ARR target. The company has now made a very public and very specific promise. If they cannot show significant sequential progress toward that goal in their upcoming quarterly reports, the shorts will be proven right, and that $200 million will be seen as just good cash thrown after bad. The second risk is the cash burn. That $28.9 million quarterly loss is a high number, and while $200 million provides a cushion, it is not infinite. They must get that burn rate under control or, more likely, scale their revenues so fast that the burn rate becomes irrelevant. The catalysts are equally clear. The most important near-term catalyst would be the announcement of a major flagship retailer signing on to use the Brain Suite. The market needs to see a proof of concept at scale.